Good morning. This is Chris Robinson. Robinson Ag Marketing with today's pre-opening grain and livestock comments for Friday, the 20th day of March. Two-sided trade last night. May corn down 3.5 cents, 466 and a quarter. Only a 3 cent range there, 4 cent range. New crop corn. I've been beating the bushes about this, guys. 494. Is that close enough to $5 for you guys? I don't know. You have to make your own decisions. 491 the last trade, down 3.5 cents. May corn down a quarter cent with another 11-cent trading range overnight. New crop beans. We have been trading here on this 1150 area. That's a pretty good gift. On the dip after the last correction, we went down to 1118. So expect lots more volatility there as beans trade with crude oil. Crude oil, that's the continuing story. We're still under 100 bucks. Last night's high 97, the low 93 half. We're trading at 95 half right now. So I guess no news is good news as far as things getting worse in the Gulf. I think it still remains to be seen when and if that strait opens up and we can get back to normal, right? Um, that has been the number one driver, the reason we had this huge rally. 1 year highs in wheat, 2 year highs in new crop corn and beans. If you are a farmer and if you were depressed in December and if you're not doing something to reward this rally, please, call me, call somebody, right? Because these prices may not last once, uh, when and if the situation in Iran gets straightened out. I would imagine that crude oil will come right back down. You got to remember, crude oil was at 55 bucks. We were at 5 year lows right before Christmas. This is completely because of the Iranian situation. And that is the reason that you had such a big spike here in the grains. In the wheat overnight, Chicago down 7 cents. Again, it's another 15-cent trading range overnight. Kansas City down 9 cents, another 13, 14-cent range overnight. So we're getting a lot of trade overnight, a lot of robot trading overnight. The Europeans and the Asians, this is all computerized trading, and the overnight trade is very, very treacherous. This is an option that really, this is a market that really lends itself to using options because you set your hedge, you can't get stopped out. If you're using futures, and you're not comfortable taking 25 cents worth of risk every day, you're going to get stopped out and you're probably going to lose your hedge just when you need it the most, right before the market turns. Moving on to the protein complex. We are going to get cattle on feed today. I can't remember the last time was we had a cattle on feed that mattered, but we're going to have one. We're going to have a hogs and fix report, which is expected to be bearish. And you're already starting to see that out there. In the deferred months, I put this in my letter yesterday. I've got some levels out there that you want to take a look at. Now, is it possible that we get a surprise and rally? Absolutely. So, if you're looking to kind of play both ends of the game, I've got no problem with you defending your unpriced animals with puts, but then having some cheap call spreads on in case, this number surprises everybody and we go back up and re-challenge the highs. I think that's how you play it. Defend your risk, keep your upside open on some cheap calls. I am, along with everybody else, kind of concerned that if and when we do get a recession in this country, if that ever shows up officially, that would be the end of the bull market that we've had since 2020 in the protein complex. So defend, defend, defend. Leave your upside open. Um, Hey, one last thing, silver. If you are not, if you're looking for a market that's moving kind of like bananas, take a look at silver. Yesterday at $10 trading range, we fell back down to 65 double. That was nearly the February low down at 64.66. And then lo and behold, what happened? Well, the machines bought it. We're trading 70, 71 here today. It doesn't take a rocket scientist or anybody with, an IQ of 400 to look and see and say, well, we tested $65 once in February. We tested it yesterday. That's going to be a pivotal area to fight over for the next 2 or 3 years. Excuse me, 2 or 3 years. Excuse me about saying that. So for the next 2 to 3 weeks, certainly, right? As the market figures out what's going on with the dollar and everything else. So right now, silver's sitting at 72. The high, the spike of the move in January, 119, 122, almost 123, 122.67. So if you're doing anything like that, you have to treat silver the same way you would treat soybeans, I think. It's great to be bullish, but you don't want to be in a situation where you're the guy that paid 122 and then you're selling that at 64 4 days later, right? You just don't want to do that. So whatever your decision, I don't care if you're bullish or bearish, just have an escape route, guys. And that is why we hedge. Uh, as far as the grains go, we're going to have on the 27th, they're going to have the celebration of agriculture. That's when they're expecting some news about the RINs and so on and so forth, the new regulations for biodiesel. And then at the end of the month, we're going to have the much anticipated, much hated, much argued about planning intentions report. So lots of risk ahead. Let's try and plan for it. This is Chris, 312 638 8868. If you're not getting my letter, go to robinsonagmarketing.com. Take a look.